Have you ever looked at a company's financial statements and felt, well, like you needed a decoder ring to understand what they really mean for the long run? Whether you're thinking about an investment, maybe checking out a job opportunity, or just, trying to understand the business world better, getting a handle on a company's long-term health is just crucial. It can seem complex, absolutely, but it doesn't have to be. Today, we're doing a deep dive into something called solvency ratios. We're going to unpack what solvency ratios actually are, how they're calculated, and maybe most importantly, what they tell us about a company's real ability to manage its debt, write out challenges, and, well, stick around for the long term. That whole going concern idea. Before we dive deeper, though, just a quick reminder that this deep dive is based on material from Farhat lectures. All the content, the examples, the explanations we'll talk about today, they're all derived from the comprehensive accounting resources over at farhatlectures.com. So whether you're an accounting student, a CPA candidate, or already a professional, you should definitely visit the website for extra practice questions, video lectures, and detailed support to really cement what we cover today. Special thanks to Professor Farhat for providing this valuable material.
Okay, so solvency ratios. You can think of them as being sort of similar to liquidity ratios, but they take a much wider view. Liquidity is about the short term, right?
Yeah.
Can you pay your bills next month?
Right.
Solvency focuses on the company's ability to pay off its long-term debt. It's about surviving for years, not just months. And it also tells you about their capacity, their room to take on more debt if they need it, maybe for growth or, just to handle unexpected bumps in the road.
Okay, so to make this really concrete, we'll be pulling examples that feel like they come straight from a balance sheet and an income statement. And like we said, those kinds of resources are often up on farhatlectures.com. Seeing the numbers makes a difference. So let's imagine we're looking at a hypothetical company, maybe Fusion Dynamics. A tech firm growing wants to expand. What's the first solvency metric you'd probably look at for them?
Good question. Often, the first stop is the debt ratio. Yeah, analysts frequently check this one first to get a quick sense of a company's leverage. What it does is show you the proportion, the percentage, of a company's total assets that are financed by debt. So basically it asks, how much of the stuff this company owns is actually owed to somebody else?
And the calculation for that is?
It's pretty straightforward, actually. You just take total liabilities and divide it by total assets. So let's say our Fusion Dynamics has $100 million in assets and $40 million in liabilities. You divide 40 by 100, you get 0.4 or 40%. Their debt ratio is 40%.
Okay, 40%. 40% of Fusion Dynamics assets are debt financed. What does that signal? My gut reaction is, well, higher debt means higher risk. Is it really that simple?
That's generally true, yeah. A higher debt ratio usually does point to higher risk. But it's a bit more than just the risk of not being able to pay.
Yeah.
See, high debt can mess with a company's credit rating. That makes any future borrowing more expensive, maybe even impossible.
Right, which could stop them from growing, even if they're profitable now.
Exactly. And it cuts down their flexibility.
Right.
If a great opportunity comes along, or they need to invest heavily in R&D, they might not be able to if they're already overloaded with debt payments. Think about airlines, for example. It's not uncommon to see debt ratios of 80%, even 90%.
Wow, that high?
Yeah, because so many of their core assets, the planes, are leased. And accounting rules, like ASC 842, those leases often show up on the balance sheet as liabilities, as debt. So it's high, but it's kind of the norm for that industry. Now, from an auditor's point of view, this ratio is critical. We don't just look at the number in isolation. We compare it to industry benchmarks, sure, but also really importantly to the company's own history. If Fusion Dynamics usually sits around 40% and suddenly it jumps to, say, 54%, or maybe it drops way down to 20%, that's a potential red flag.
Okay.
We need to dig in. Is there debt hidden somewhere? Did they suddenly pay off a huge loan? Did they sell off a big chunk of the business? What you want to see is either stability or changes that make sense that are explainable. That signals health.
Okay, so the debt ratio tells us the owed part, but what about the flip side? How much is owned free and clear by the shareholders? I guess that's where the equity ratio fits in.
Precisely. The equity ratio is just total equity divided by total assets. And here's the neat part. The debt ratio and the equity ratio will always add up to 100%.
Ah, okay.
So back to Fusion Dynamics. If 40% is debt, the other 60% has to be equity. That 60% represents the owner's stake, things like retained earnings, the money they've reinvested, plus common stock, preferred stock, and so on.
A higher equity ratio then. That sounds better, right? More ownership, less debt. Is there ever a case where having too much equity, not enough debt, could be a negative, like maybe being too safe?
That's a really sharp point. Generally, yeah, more equity means more flexibility, less financial risk. Equity holders don't have fixed payment demands like lenders do. They're usually more patient. Debt, like you said, carries that fixed interest payment burden. Got to pay it, good times or bad. That's risky. But relying only on equity could mean a company misses out. Debt, used smartly, can be cheaper than equity capital and can act like a lever.
A lever, how so?
It can amplify returns for the equity holders if the investments funded by that debt pay off well. In the Farhat material, there was an example where the company went from 54% debt and 46% equity in 1 year
Okay.
to less debt and more equity the next year.
Yeah.
That's often seen positively, like they're reducing risk.
Yeah.
But it is always a trade-off, a balancing act.
Okay, this makes sense. But if you really want to zoom in on how much of the company's operations are funded by borrowing versus the owner's own investment, I think you mentioned the equity multiplier. That sounds like another angle on leverage.
Absolutely. The equity multiplier gives you another perspective. You calculate it by taking total assets and dividing by total equity. Imagine Fusion Dynamics was 100% equity financed. So $100 million assets, $100 million equity.
Right.
The equity multiplier is $100 million, which is 1. Every dollar of assets is backed by a dollar of owner's equity. But now let's use our earlier example. $100 million, but only $25 million in equity. That means the other $75 million must be debt.
Right. 75 plus 25 equals 100.
Exactly. So the equity multiplier is $100 million, $25 million, which equals 4.
An equity multiplier of 4. So for every $4 of assets the company controls, only $1 is from the owners, and the other $3 must be from debt.
Whoa. That sounds like a lot more risk writing on things.
It is, precisely. The higher that multiplier, the more leveraged the company is. And yeah, the higher the risk. It's a bit like buying a house with a tiny down payment and a huge mortgage. Your personal equity multiplier is high. You control a big asset with little of your own cash tied up.
But if house prices drop, you're in trouble quickly. Same idea for a company. The owners might have less of their own money at risk up front, sure. But if things go sour, the debt holders are the ones who really bear the brunt of the losses potentially. It really highlights how much of Fusion Dynamics operations in that scenario are fueled by borrowed money versus owner investment.
That paints a very clear picture. Okay, let's touch on the debt to equity ratio quickly. Sounds like another way to slice the same pie.
It is, yeah. Very related. You calculate this one by taking total liabilities and dividing it by total equity. It's a very direct comparison, how much debt versus how much equity. And it connects right back to the equity multiplier. Often, if you take the equity multiplier and subtract 1, you basically get the debt-to-equity ratio, or something very close, depending on the exact structure. So, in our example, where equity multiplier was 4, a debt-to-equity ratio of 3, which is $75 million debt, $25 million equity, means for every $1 the owners have put in, the company has borrowed $3. It just reinforces that trade-off again. More debt equals more risk for the company itself. But if things go well, that leverage can boost the returns for the shareholders because they're using other people's money to generate profits. So if we tie all these leverage ratios, debt ratio, equity multiplier, debt to equity together, you can start to see why they're so vital for auditors. Because fundamentally, high leverage usually means high risk, period. And high risk creates pressure. Pressure on management, maybe pressure to, let's say, fudge the numbers or use aggressive accounting tactics to make things look better than they are, maybe to meet loan covenants or just keep investors happy.
Okay. So when auditors see those ratios climbing, like if Fusion Dynamics debt ratio or equity multipliers creeping up year after year, it's not just an interesting number. It's a signal, right? The signal of potential financial stress that needs a much closer look.
Exactly right. It tells us where to focus our attention. And that brings us neatly to another really important solvency ratio, the times interest earned ratio, often called TIE. This one specifically measures how well a company's operating income can cover its interest expenses. Can they actually afford the interest on all that debt they might have?
Okay, and how do we calculate the TIE ratio?
The formula for TIE is income before interest and taxes. You'll often see that called EBIT divided by the interest expense for the period. So let's say Fusion Dynamics has EBIT of $10 million and their interest expense is $2 million.
Okay.
Their TIE ratio is $10 million divided by $2 million, which equals 5. That means their operating income is 5 times greater than what they need to cover their interest payments. Generally, a higher TIE is definitely better. It shows there's a good cushion, more protection for lenders and investors. It says, yeah, we can comfortably handle our interest obligations.
5 times cover sounds pretty good. Is there ever a downside? Like, can the TIE be too high, or is it just always more is better?
That's a subtle but good question. Usually higher is better, yes. But an extremely high TIE, way out of line with peers or history, could sometimes be a quiet little flag. It might suggest the company isn't taking on enough potentially productive debt for growth. Maybe they're being too conservative. Or perhaps their interest expense is artificially low because of some complex, maybe unsustainable debt structure. And you also have to remember, TIE only looks at interest expense. It doesn't factor in paying back the actual principal amount of the loans, which is often a much bigger cash drain.
Ah, good point.
So for a really full picture of their ability to meet all fixed obligations, analysts might look at other ratios too, like the fixed charge coverage ratio, which usually includes things like lease payments and principal payments.
And the auditor's role here, again, looking for deviations. If Fusion Dynamics tie is suddenly much lower than expected, that's obviously a worry, but if it's suspiciously higher,
Yes, either way, a significant unexplained change warrants investigation. Lower signals immediate financial distress, potentially. Much higher might suggest, as we said, maybe odd financing, or it could even point to manipulation of the earnings number, the EBIT, to make things look better. And another useful thing for auditors is that you can often estimate what the interest expense should be, roughly, just by looking at the company's outstanding loan balances and prevailing interest rates.
ah, like a reality check.
Exactly. It provides an independent check on the reported numbers. And like all these ratios, the trend is key. Looking at Fusion Dynamics TIE over several years tells a much richer story than a single snapshot. A sudden break from a stable trend demands explanation.
Okay, so pulling this all together, what's the big takeaway for you listening? These solvency ratios, the debt ratio, equity multiplier, debt to equity times interest earned, they give us really vital clues about a company's long-term financial strength. They're not just abstract numbers on a page, they offer a powerful lens into how well a company can manage its debt, if it's built to last through tough times, and ultimately, its real potential to survive and hopefully thrive.
It may be a final thought to leave you with. Think about how a company's solvency position, how much debt it carries, how easily it covers interest, fundamentally shapes its big strategic choices. Can Fusion Dynamics actually afford that big R&D push for the next breakthrough product? Can they snap up a competitor? Are they solid enough to weather a recession, or will high debt payments cripple them? Could they even attempt that ambitious global expansion? These ratios reflect deep-seated decisions about risk versus opportunity, and those decisions really dictate the company's entire future path. The numbers tell a story about choices.
Absolutely. So we really encourage you, don't just listen, engage with these ideas. Go find the financial statements of a company you're interested in. They're usually public for listed companies. Or, as we've mentioned, check out farhatlectures.com, work through some examples there, play with the numbers yourself, see how changing assets or liabilities impacts these ratios. That hands-on practice is genuinely the best way to deepen your understanding and become, well, a much sharper financial